Welcome to Standard Costing and Master Budget. Today we link per unit benchmarks established through standard costing with the comprehensive plan of a master budget. You will learn how to set standard costs for materials, labor, and overhead, and then compile sales forecasts into a master budget that drives production and cash planning. By the end, you'll be able to build these financial tools and comprehend the role of the flexible budget. Before diving into mechanics, consider why organizations budget. First, planning compels managers to anticipate sales and production needs, ensuring timely scheduling. Second, budgets provide benchmarks for spending and control, identifying overages or shortfalls. Third, coordination aligns different departments onto a single operational playbook. Fourth, performance evaluation at period end helps pinpoint successes and areas for improvement. Reflect on this. The budgeting process not only creates structure, but also drives strategic decisions across the organization. Which function do you believe companies struggle with the most? Let's bridge your existing knowledge to today's topic. You've mastered job order and process costing, which explain how costs flow, and normal costing that uses predetermined overhead rates. Today's standard costing extends these principles to all cost inputs, transforming estimates into comprehensive benchmarks. The master budget then applies these per unit standards to anticipated production volumes. Finally, variance analysis evaluates whether the standards and budgets held up against actual performance. This integrated approach equips you to tackle both exam questions and real-world challenges. This is the pivotal slide. Every costing system answers two independent questions. First, how do costs flow to products? And second, what cost inputs are employed? Whether using job order or process costing, each method addresses unique production needs. Similarly, choosing between actual, normal, or standard costing reflects the extent of estimation involved. These choices operate independently, allowing diverse combinations. Consider if you ran a brewery. What combination would best suit your operation? Reflect on how diverse combinations can drive efficiency and innovation. Let's dive into this essential comparison. On the left, normal costing employs actual direct materials and labor with overhead applied via a predetermined rate, producing only overhead variances. On the right, standard costing uses predetermined rates for all components, direct materials, labor, and overhead, resulting in multiple variances for price and efficiency. Notice that under standard costing, unit cost is known even before production begins, which is invaluable for pricing decisions. Study it carefully to understand each diagnostic measure. Consider costing as an evolution, not three unrelated systems. Actual costing means waiting until period end, fine for small shops but unsuitable for large manufacturers. Normal costing improves timeliness by estimating overhead with a predetermined rate, creating one variance. Standard costing extends this by presetting benchmarks for materials, labor, and overhead. Each speeds decisions. Now that we know what standard costs are, let's talk about setting them effectively for better planning. A standard cost card has three components. First, standard quantity defines the input per unit, measured in pounds, yards, or hours from engineering studies. Second, standard price indicates the cost per input unit, derived from contracts and market analysis. Third, standard cost is computed by multiplying quantity by price. For example, a snowboard requiring 9 board feet of wood at $34 per unit totals $306. Fill in your cost card now to complete your understanding. Standards are a collaborative effort. Industrial engineers determine quantity standards using time and motion studies and waste analysis. Purchasing establishes material price standards based on supplier quotes and volume discounts. HR defines labor rate standards from union contracts and benefit data. Cost accounting compiles the standard cost card using the same predetermined overhead rate. Finally, senior management decides between ideal and practical standards. Now let's discuss that strategic choice between ideal versus practical benchmarks clearly. Ideal standards assume perfect conditions with zero waste and downtime, but they often demotivate employees due to constant unfavorable variances. Practical standards allow for normal waste and predictable downtime, offering achievable and motivating targets. Some companies even practice Kaizen budgeting, gradually tightening standards over time. As a new manager, which standard would you choose? Consider the message each option sends. Now, having established per-unit benchmarks, let's scale them up to the entire organization. Standards serve as per-unit building blocks, defining the cost for one snowboard, one widget, or one service hour. The master budget multiplies these unit benchmarks by planned volume to form an organization-wide financial plan. In essence, standards answer what one unit should cost while the budget reveals the total annual cost. Every budget component builds on these fundamentals. Notice the link when you see standard price multiplied by budgeted production measures for clarity. The master budget divides into two sections. The operating budget covers everything from the sales forecast to the budgeted income statement, following an accrual basis of earnings and spending. The financial budget includes capital expenditures, cash flows, and the budgeted balance sheet, emphasizing cash timing. For example, although the income statement may report $1 million in revenue, $800,000 might be collected. This difference represents accounts receivable. Each component cascades, beginning with the sales forecast. Let's walk through the cascade from left to right, beginning with the sales forecast that drives the entire master budget. The sales forecast feeds into the production budget, determining required production through expected sales and desired ending inventory. Then, the DM, DL, and MOH budgets use standard costs, calculated as production units multiplied by standard quantities and prices. Notice our standards in action callout, highlighting that if the sales forecast is off by 20%, every subsequent budget is affected. Let's work through a concrete example beginning with the production budget formula. Start by adding budgeted sales of 1,000 units to a desired ending finished goods inventory of 150, then subtract the 100 units in beginning inventory to arrive at 1,050 units required. Remember, this figure represents units only, not dollars. Once determined, apply standard cost multipliers for DM, DL, and MOH as shown in the Standards and Actions section for precise budget calculations. Now let's trace the next step, determining raw material purchases. Begin by calculating production needs as production units multiplied by 2 pounds per unit. Next, add the desired ending raw materials, set at 10% of the following quarter's production. Subtract the beginning inventory, which carries over from the prior quarter, to determine the pounds to purchase. Finally, multiply the purchase quantity by the standard price of $3 per pound. This anticipatory approach secures inventory continuity. In the cash budget, accrual meets cash flow. Start with the beginning cash balance, then add cash receipts from customer collections. Remember, revenue recognition differs from cash receipts. Subtract cash disbursements for materials, labor, overhead, S&A, capital expenditures, and loan payments to determine the ending cash before financing. Adjust for financing activities to arrive at the final cash balance. Note: depreciation is excluded as it does not impact cash flow. This slide demonstrates the distinction between cash and accrual accounting. Review the tables. For cash receipts, AR policy collects 60% in the current quarter and 40% in the next. For cash disbursements, AP policy splits payments 50/50. Notice that Q2 sales of $240,000 result in only $224,000 in cash due to timing lags. Changing the AR policy shifts timing, affecting quarterly cash flow, while total amounts remain unchanged. Students often stumble on this question. Is the master budget a static budget? The answer is yes. It is built for one planned level of activity and does not adjust to actual volume. In the table, observe that the static budget is used for planning and coordination, while the flexible budget adapts to real performance. Both use identical cost formulas. The only difference is the volume input. Let's see when budget type is applied. Consider the timeline. Before the period, you set standards, build the master budget, and approve capital expenditures. During the period, You execute the plan and track actual costs while updating rolling budgets as needed. After the period, the flexible budget emerges, recalculating expected costs at actual volume to reveal variances. Remember, the master budget exists in planning, while the flexible budget reflects real outcomes using identical formulas. Can you see the distinction clearly? Students wonder, do I need standard costing if budgets merely multiply standards by volume? Technically, you could rely on historical averages. However, without standards, you simply arrive at a lump sum with little detail. With standards, you apply per-unit benchmarks that break down costs into price and usage variances. This gives you diagnostic power to pinpoint issues. In short, standard costing transforms a budget from a static plan into a detailed performance tool. In this preview, we introduce the framework for variance analysis. Total budget variance splits into direct materials, direct labor, and variable overhead components. Each component separates further into a price or rate variance and a quantity or efficiency variance. For direct labor, we refer to rate and efficiency, for materials, price and usage, and for overhead, spending and efficiency. This lays the groundwork for deeper analysis next module. It primes our next studies. Imagine a scenario where a company budgets 10,000 units at $2 per unit, totaling $20,000, but ends up producing 12,000 units and spending $26,400. A naive comparison shows a $6,400 overrun. However, when comparing apples to apples, the static budget remains at $20,000, while a flexible budget adjusts to $24,000 for 12,000 units. The variances are a $4,000 sales volume variance and a $2,400 flexible budget variance, highlighting the logic behind flexible budgeting. Let's wrap up with 5 key takeaways. First, remember that costing systems have 2 dimensions, cost flow and cost inputs. Second, standard costing extends the PO-char concept to all inputs. Third, standards form the per-unit building blocks that the master budget multiplies by planned volume. Fourth, the master budget is static while the flexible budget adjusts to actual volume. Fifth, the complete cycle, from standards to variance analysis, drives corrective action. Any questions? Please share thoughts.